All right, let's get right into it. If you're a self-employed U.S. expat, there is a huge, and I mean huge, misconception out there that can lead to a massive unexpected tax bill. It's this belief that if you file Form 2555, you've basically wiped your slate clean with the IRS. Well, in this explainer, we are going to break down exactly why that idea isn't just wrong, it's actually pretty dangerous for your finances.
So let me just ask you this straight up. If you're an American running your own business, living and working overseas, do you think the foreign earned income exclusion makes you totally tax-free in the States? If you're nodding your head yes, hey, you're in good company. But you are also walking straight into a trap we call the Self-Employment Tax Ambush. So here's our game plan. First, we're going to define what this ambush actually is. Then, we'll look at what Form 2555 really does before we get into the nitty-gritty of the legal firewall that keeps income tax and self-employment tax in separate boxes. We'll even walk through the confusing calculations, talk about the one big exception to the rule, and then wrap up with some key takeaways you have to know. Okay, so what is this ambush I keep talking about? Well, picture this. A self-employed expat files their return. They're thrilled to see a $0 income tax bill because of the foreign earned income exclusion. But then, wham, they get slammed with a huge, totally unexpected self-employment tax bill. And listen, this is not some kind of clerical error. It's exactly how the system is designed to work.
And this, right here, is the absolute heart of the problem. People believe the exclusion just saps all U.S. tax. But the reality? You've only dealt with one kind of tax. That other one, that flat 15.3% tax on your net profit that funds Social Security and Medicare, is completely untouched. It's still there, and it's waiting for you.
Now, to really get why this is a trap, you first have to understand the tool itself. Form 2555, which lets you claim the foreign earned income exclusion, is a fantastic tool for what it's meant to do, which is slashing or even getting rid of your U.S. income tax. But, and this is a big but, its power has very, very specific limits.
And, getting to use this tool isn't just a given. The IRS has some pretty strict rules. You have to have a tax home in a foreign country, and on top of that, you have to pass one of two tough tests. There's the bona fide residence test, where you have to be a legitimate resident of another country for a whole tax year. Or there's the physical presence test, which is just a numbers game. You have to be physically outside the U.S. for at least 330 full days within any 12-month stretch.
And the key word to focus on here is earned. It's so important. This exclusion only works for money you get from your actual work, your consulting fees, your business profits, any passive income, stuff like dividends from your stocks, interest from savings, rental income, that is totally ineligible. It stays fully taxable in the U.S. No exceptions.
All right, now for the really technical part. Let's look at the legal reason this ambush exists. And I want to be clear, this isn't some weird IRS interpretation or a loophole somebody found. It is a hard-coded separation that's built right into the U.S. tax code. The best way to think about it is like a solid firewall between two different kinds of tax. So here's the breakdown, right from the code. The Foreign Earned Income Exclusion, which comes from Internal Revenue Code Section 911, lives entirely inside Chapter 1 of the tax code. That chapter is all about income tax. But the self-employment tax, or SEA tax, is governed by a totally separate section, Chapter 2. Legally speaking, they're like two separate universes that never ever cross paths. And if you want proof, here it is. This is the exact wording that builds that firewall. Internal Revenue Code Section 1402A11, the part that literally defines net earnings from self-employment, has this little sentence tucked inside. It states plain as day that the exclusion from Section 911 shall not apply. That's it. That's the kill switch that makes it impossible to use the foreign income exclusion against your self-employment tax. Okay, so we've got the legal stuff down. Now let's see how this actually plays out with real numbers. We are going to walk through the actual calculations step by step so you can see the ambush happen right before your eyes. This is where the theory turns into a very painful tax bill. You'll see the process is kinda backward. You start with your normal business profit on Schedule C. Then, and this is the key part, you calculate your full self-employment tax on Schedule SE. It's only after you've done that you go back and figure out how Form 2555 forces you to disallow some of your expenses, which means you end up with two totally different profit numbers. It's wild. So let's just use a simple example. Let's say you're a consultant living in Dubai. You make $150,000 in revenue, and you have $50,000 in business expenses. The first step on your Schedule C is easy, right? That's a net profit of $100,000. That's our starting number. And right here, this is the most important part of the whole thing. When it comes to self-employment tax, the math stops. That entire $100,000 of net profit goes straight over to Schedule SE. Form 2555, the Foreign Income Exclusion, the system pretends they don't even exist for this calculation, just like that law in IRC Section 1402 says it should. So what's the damage? A tax bill for about $14,130. That is the ambush. While you're busy trying to get your income tax down to zero, this 15.3% tax on almost all of your profit is calculated, and there is no way to get out of it. Oh, but wait, it gets even more complicated when you go back to your income tax. See, the IRS has this rule against double dipping. Basically, you're not allowed to take deductions for expenses that helped you generate income you're not even paying tax on. So to enforce this, you have to do this whole other calculation to figure out your disallowed ratio and shrink your deductions. And look at this table. This is really the final result of all that math. For your income tax, after the exclusion and disallowing expenses, your taxable profit might only be around $30,000. But for self-employment tax, it's still the full $100,000. You literally have two different profit figures for two different taxes on the very same tax return. So you're probably asking, is there any escape from this? And the answer is yes, there is one way out. But it has absolutely nothing to do with Form 2555. The only real shield against U.S. self-employment tax is something called a Totalization Agreement. What are these things? Well, they're basically special treaties that the U.S. has with a handful of other countries. Their whole purpose is to figure out which country's social security system you should pay into, so you don't get stuck paying into two systems at the same time on the same income. And here's where it becomes a kind of high-stakes lottery based on where you live. If you're in a country like France or the UK, great, you have a way to get an exemption. But if you're a self-employed American in a huge expat hub like Dubai, Singapore, or Hong Kong, there's no agreement. You have zero defense against that 15.3% US SE tax. And even if you're in one of those lucky treaty countries, the exemption isn't automatic. You have to go and apply for a special document called a Certificate of Coverage from that country's Social Security office. This piece of paper is the only thing the IRS will accept as proof that you're exempt. If you don't have it, the treaty is useless to you. Okay, to wrap this up, let's talk about the collateral damage, because on top of the big SC tax ambush, just choosing to use Form 2555 can create a whole bunch of other headaches for your financial planning. You can really see the domino effect here, can't you? Because you've legally excluded your earned income to save on taxes, you've also wiped out your ability to contribute to American retirement accounts, like an IRA or a solo 401k. You lose some key deductions, and this is the ironic part, it can sometimes even push your income up in a way that makes you liable for other taxes, like the net investment income tax. So I want to leave you with this one final question to think about. We've seen that having a tax home lets you use Form 2555, which solves your income tax problem. But for a self-employed person, that 15.3% SE tax is often the bigger, nastier bill. And the only thing that solves that problem is being in a treaty country. It really makes you rethink what's most important when you're planning your taxes from abroad.